Good morning. These are the things that matter most in the European market today. Asia has a stronger tech mood. Oil has retreated after Middle East de-escalation hopes. And Europe enters the session with one hard question. Is this a real earnings rally or only relief from yesterday's stress? Start with the setup. Public market feeds this morning show Asia shares lifted by technology optimism, while Reuters reports oil retreating after the latest de-escalation headlines. That helps Europe at the open because lower crude can ease the inflation, airline cost, and margin narrative. But relief is not proof. Europe still has to show that earnings quality is broad enough beyond a few index leaders. The first main topic is the AI earnings read-through. Reuters reported record U.S. indexes after upbeat company forecasts and AI-linked earnings. That can support Europe's semiconductor and software chain, but it should not become a blanket green light. For ASML, SAP, and Infineon, the test is still orders, cloud demand, industrial budgets, and margins. AI momentum matters only if company-level evidence follows. The second topic is oil and rates. Oil falling after diplomacy hopes is constructive for Europe, especially airlines, chemicals, logistics, and consumers. The risk is that the market treats one oil move as a full macro reset. Eurozone yield stories and ECB communications still matter because banks, property-linked lenders, and leveraged firms react very differently to the same rate backdrop. Third, earnings quality and luxury. Autos and travel remains the European stress map. Recent Reuters coverage of mixed luxury earnings, airline dichotomy, Marriott's Middle East revenue weakness, Toyota's forecast reaction, and earlier Stellantis pressure all point to the same filter. Premium demand, China exposure, travel routes, and pricing power must prove themselves separately. Brand strength alone is not enough. The underappreciated story is that lower oil can hide the travel split. Most investors will see cheaper crude and think the airline problem has eased. But the more important question is whether fares, routes, occupancy, and premium spending are still healthy. If Middle East stress changes travel patterns, or if consumers trade down, Europe can get oil relief while still losing earnings quality. Here is the stock-led watch list for the day. First, ASML, SAP, and Infineon. Does AI optimism translate into European order and margin proof, or is the move still dependent on U.S. megacap confidence? Second, Lufthansa, IAG, and Ryanair. Does lower crude improve the setup, or do routes and fares reveal the travel split? Third, LVMH, Mercedes-Benz, and BMW. Does premium demand stabilize, or do China exposure and pricing pressure keep weighing on margins? Fourth, BNP Paribas, Société Générale, and ING. Do banks confirm resilience, or do rates expose fragility elsewhere? Market bias for Europe today is constructive but proof-led. The bullish case needs AI read-through, oil relief, and bank resilience to translate into visible earnings quality. The cautious case is that Europe is still too dependent on a small number of strong narratives while autos, luxury, and travel quality remain uneven. The mistake to avoid is treating lower oil or a higher index as proof that every European theme is healthy. Today's filter is simple: separate relief from confirmation. Companies need demand quality, margin protection, or balance sheet strength before the market can trust the move. That is the Europe Morning Market Brief for August 5, 2026. Watch AI proof, oil relief, banks, luxury, autos, and the travel quality split. Back later with the next setup if the tape changes. Research context only. This briefing is not investment advice.